Hello there, everybody. Hope you're doing okay. Good afternoon, everyone, and welcome to B&M Care's funding webinar in association with Solid Accredited Financial Advisors, Eldercare Solutions. My name is Angela Hunt, and I am the Sales and Marketing Director for B&M Care Homes. A warm welcome to our existing families joining the webinar today, and also welcome to those of you out there stepping into the world of accessing long-term care for your loved ones and wading through the minefield that is finding ways to fund that care. B&M Care have been operating care homes for over 50 years now. We take the view that providers like us have a real responsibility to share our knowledge with our families as well as the wider community. So today's webinar is part of a series of discovery events that we deliver, which includes the in-person How to Live Well with Dementia and the virtual dementia tour. You can visit our website, bmcare.co.uk/events for any of our upcoming dates. So let's move on to today's event. I'll hand you over now to Nikki Cave from Eldercare Solutions, who is going to take you through today's care home funding webinar. Nikki, over to you.
Thank you very much, Angela. I'm just going to do my tech and hope that works. Is that all visible to you? Perfect. Thank you. So yes, welcome to our funding event. It's I can't remember, the 5th or the 6th of September today, but we're in September 2024. So I just wanted to stamp this for anyone watching the recording, just so you know the information is current as at today's date. And what we're going to run through over the next 50 minutes or so, I think it's usually about 55 minutes, we're going to try and make what looks like a very complicated road sign there. Those words have all been picked deliberately. We're going to make this sort of confusing, perplexing journey hopefully a little simpler for you. And I do appreciate, as we go through the event, that everybody watching is going to be at a different stage. So some of you will be at the very, very beginning of the journey, and some of you may have sort of navigated some of it already. So I'm going to sort of be taking the start position that people watching have very limited knowledge. So if some of you do already know some of the areas I'm going to cover, I shall apologise in advance. As I say, we are recording this, and if anyone has very bespoke questions about their individual circumstances that don't get answered as we go through this, I'll make sure that our contact details are displayed, and you can get in touch for sort of one-to-one private chat, or obviously contact Angela to get our details. So what we're planning to do is answer the very simple question, complicated answer, who actually pays for a stay in a care home? We're going to look at what has happened to the lifetime cap on care costs that was promised by several previous governments. We will look at whether the family home has to be sold to pay for a stay in a care home. And then we'll look in closing at whether there is a legal and legitimate way to ring fence legacies for beneficiaries and make sure that any money that's been put aside or earmarked pay for care, to make sure that that doesn't run out, if at all possible. You'll see our website address displayed throughout, so there's a wealth of information on there, and you can actually contact us through the website if you want to. Just before I start working through that agenda, which hopefully it looks like all the areas that you were hoping would be covered, let me just introduce ourselves in a bit more detail. We are a firm, as Angela said, of Solid Accredited, the Society of Later Life Advisors, accredited IFAs. So if you haven't heard of that organisation, it's a sort of independent accreditation, somebody looking at what we do, looking at our client files, understanding our knowledge and saying, yes, you meet the gold standard to talk to people about later life matters. Solar is not in itself a company, so IFA firms can be members, individual IFAs can be members, but of course that means we all do things differently. So at Eldercare, we specialise exclusively in solutions for care fees funding. So whilst, as I say, we are IFAs and have the qualifications to talk about pensions or mortgages or protection, that's not what we do. We only talk day in, day out to families who are looking at how best to pay for a stay in a care home, usually for their loved one rather than for themselves, but for themselves sometimes. So that's our niche. And what that also means is if you're talking to an IFA who does give advice around pensions or mortgages and protection, they may not give care funding advice very often. So they won't necessarily be a specialist as we might be. The business is actually mine, and it was set up in its current format back in 2007, really as a result of our family going through what some of you might be going through. And we were looking at ways to fund my grandparents' stay in a care home and getting absolutely no advice. That wasn't because anyone is to blame for that. We just didn't know what we didn't know. So we didn't ask to be signposted anywhere. We genuinely thought we knew what we were doing. We thought there were no alternatives than to sell the property, keep our fingers crossed and hope the money lasted. So that's what we did. And by the way, the money didn't last. So I got on my soapbox after that when I found out that there were alternatives, and the idea of the company in essence is just to share that information with as many people as possible so that you can make more informed decisions than my family did. And whilst we're here at B&M's kind invitation, we have no commercial link with them or with any other care providers. This is just about getting the right information to the people that need it at the right time. We are having money conversations with families, so it's really important that you can check we are appropriately regulated, and you will be able to easily find us on the Financial Conduct Authority register. That's where you should look and check for anybody that you're having any money conversations with. That's sort of an obvious way to cut out any risk of scammers. So you'll find us on the FCA register. And whilst we're based actually in Hertfordshire, as are probably many of you, it doesn't really matter because we deliver our service and our advice remotely. And we were doing that even before COVID times when we all got introduced to Zoom. So the reason we do this is really so that there's a clear audit trail, so that if we're talking to one member of the family and they've got an email, they can easily pass it on to their sibling and not have to sort of lose things in translation. But it also keeps our cost base down. If we are not having to bill for time travelling or stuck in traffic, etc., then we can offer an initial conversation, an initial consultation, and even a research of financial solutions, all of that at our expense, not yours. We don't have to send you an invoice for an initial consultation because we're doing it remotely. So that's a bit more about us. You can read a bit more about the backstory on the website, but back to the agenda. And that, as I say, simple question, who pays for care? Not such a simple answer. If I try and simplify it, I can say that there's really three funding streams. You are either paid for by the local authority, social services, the council. It's all the same place, but just called different things, helpfully. You might, in certain circumstances, be paid for by our much-loved National Health Service. Otherwise, you are a self-funder, private fee payer. You can get some crossover between the three, but as I say, I want to try and keep it simple for today. Taking them one by one, if we look at the local authority funding first, I think people associate this system, if they know anything about it, they associate it with how much money you have or don't have. The reality is something should happen before there are any conversations about the money, and that is that the care needs assessment should be carried out. And in order to get any funding from the local authority, when that care needs assessment is done, you've got to meet their specific eligibility criteria. So if they assess somebody's needs and they don't think those needs have to be met in a care home, they think those needs could be met staying in one's own home, then the money conversation doesn't really go any further. They say, well, you don't meet our eligibility criteria, so we're not going to pay for you regardless of your financial position. Anybody can have a care needs assessment. A carer can have a care needs assessment, but we are all able to have one. These should be carried out by a social worker from adult social care. Now, as I say, it's important that this happens first, but in reality, often a call is made to adult social care and they ask how much money you have. you do need to push back on that and say, let's discuss the finances once we know what the care needs are. When we know what the care plan looks like, then we can work out who's going to pay for it. So that's when the financial assessment happens. And that financial assessment is more commonly referred to as a means test. You may have heard that term used. So a social worker carries out a means test. What are they looking to, bottom line, ascertain? How much money you have. You will probably know this figure, I'm sure, and if we were in a room together, you'd be shouting it out at me. They're looking to see, in England at least, and Northern Ireland, whether you have above or below £23,250 of capital. People think it's better in Scotland, it's free in Scotland. It's actually only a little bit more generous in Scotland. It's actually at its most generous in Wales, where the limit is £50,000. And these figures are per person, so we can double them for a couple. In Wales, it's a flat 50,000. They don't have a lower limit. In England, we also have this lower limit of 14,250. And people get a bit confused about what the difference is between the two limits. There's very little difference between the two limits. All it is that you have to pay something called tariff income, which is where you have to still pay £1 for every £250 of capital you have between the upper and lower limit. You still have to make that contribution towards what the local authority pay, as well as contributing your income, of course, which I'll come on to in a bit more detail in a second. So it's a bit more complicated with that upper and lower limit, but that's the difference. There was talk that this 23,250 was going to increase substantially and practically quadruple and become an entry point of £100,000. That was due to happen initially last October. Then it was postponed to next October. And unfortunately, it's now been shelved altogether. So for the foreseeable, our means-tested care, our means-tested support will only kick in when somebody's capital gets to 23,250 or under. What counts as capital? Well, pretty much everything. I'm going to just draw out 3 exceptions that I think are worth a mention. If we are talking about couple scenario with maybe just one of the couple going into care, then it is only the person going into care whose capital is assessed. So we are assessed as individuals, not as a couple. Even if everything's held jointly, then it's only half of the joint assets that are included in the means test, and 100% of the capital owned by the one staying at home, that does not get included. That's an exception. So there is absolutely a time and a place for separating out our jointly held assets. It keeps it much cleaner and clearer for the local authority assessment, and it prevents the person who doesn't need care, it prevents their assets being accidentally used to fund care. So if there is a joint account with £100,000 in it, just split it out. Don't mess with the percentages. Just put 50,000 into 2 sole accounts. Okay, that would be advisable. If you're doing it well ahead of time, well ahead of care being needed, again, you don't know who might go into care first, if either of you. So separate it out. There's a Good Age UK fact sheet that explains a bit more than I'm able to today. So that's one exception worth mentioning. The next exception is the family home. So many people are misadvised, misinformed, or have misunderstood this, but if the family home is going to still be occupied by a spouse after one of them moves into care, or indeed a relative over 60, that property value is disregarded. They're not, the local authority, going to come back at a later stage and retrospectively take money back. That property is invisible if a spouse lives in it, or indeed if somebody's having care in their own home. That's a different scenario altogether. But if one of 2 moves into care, one stays at home, the property value has to be ignored until such time as the second spouse either goes into care themselves or predeceases the one in care. From that date forward, the property value would then be included. There is no retrospective coming back in years into the future to say, oh, we paid for the care for 3 years and we're going to come back when the house is sold and take the money. Absolutely not. As for the relative over 60 living there, if that relative over 60 has just moved in on the day mum or dad moved out into care, of course that won't be an exception. But if they genuinely live there, that's their home, they're aged over 60, the property value can't be included now or ever until such time as that over 60-year-old moves out themselves. So that's really hopefully reassuring to people that might be worried about that situation. And again, if we've got a couple, one moves into care and the other thinks the house is too big and they should downsize, just be mindful that any money that's released as a result of that move, if it is to a cheaper property, half the money that's released would then have to be disclosed. So we sometimes say to people, well, maybe move to a smaller, more manageable property, but one that's worth the same. And that way the money remains protected. The third exception probably applies to less people, but worth a mention: investment bonds of a certain type that include life insurance. They're a disregarded asset as well. We can spot them quite easily just by looking at the paperwork. Usually you'd have had advice from an IFA to take one out rather than going and buying one directly. They're not these sort of building society bonds. These are through life insurance companies. The value can go up as well as down, that sort of wording. So they're a disregarded asset, which you can choose to cash in, but you don't have to, and you shouldn't do to start with. They are an exception. Otherwise, rental properties, holiday lets, money under the bed, ISAs, stocks and shares, premium bonds, all of those things are going to be assessed and included when they're looking at that means test. What we then have to remember, and I alluded to it earlier, was that income counts as well. So when the local authority are working out, yes, we're going to pay for you, this is how much we're going to pay per week, they are going to expect you to contribute practically all of your income towards what they pay. So it's a joint contribution. It's not they will pay this and you add your income on top of it. You give them your income, all bar a small sort of £30 a week personal expenses allowance that you're allowed to keep. If you're married and you have a private pension, then you are allowed to carry on paying 50% of that to the spouse at home, but otherwise everything else you have to contribute towards what the local authority will pay. And they will, of course, limit what they'll pay. They don't have a massive budget, as you can imagine, and it's getting squeezed more and more. But if you are funded by the local authority from the beginning, from outset, then the local authority has to find and offer you a care home place that meets your needs and that they will pay for in full, accepting you have to give your income towards it, but that no other person, no third party, would be required to have to pay a top-up. There must always be at least one no top-up option offered. They can't just give you a list of care homes and say, off you go and choose, and then every care home you get in touch with says they want the top-up. No, you have to go back to the local authority and say, well, where is our no top-up option? If you are offered a care home place that the local authority is going to pay for, but you don't like it, or you would prefer to be somewhere else, then of course you can choose somewhere different and the local authority can just transfer across what they would have paid that home to the home of your choice. But in that situation, absolutely, a third party top up can be requested by that care home. So if it's a care home who doesn't accept local authority rates from the beginning, they could say, yeah, well, we'll take that, but we'll expect a third party to make up the difference. So that's perfectly acceptable. But for people who don't have somebody able to pay a top up, that's why there needs to always be a no top up option offered. The other time a third party top up can be requested by a care home is if a person moves in as a self-funder and runs out of money at some point, depending when that happens. So depending how soon it is after they've moved in, depending what conversations took place with the care home at the beginning, and it depends really what the contract says about this scenario occurring, it could be possible that the care home, the local authority can't come to an agreement of a fee that's acceptable to both of them, and then the care home could ask for a third party top up in that situation as well. So have those conversations up front when choosing a home, just so you know where you stand. And if the care home says, well, we need self-funding fees paid for 3 years or 4 years, and then we'll accept local authority funding, there's no need for a top-up, you can budget and see whether you can afford that. Some care homes may say, no, we have to have that full fee paid for the entire duration of the resident's stay with us. So again, you would know that there would be a top-up paid almost indefinitely in that situation. So ask these questions and make sure, again, it might be a conversation with someone like ourselves just to do some cash flow forecasting, make sure that you can meet the care home's requirements. So that's our means tested system. We've had it for a very long time. It is there as a safety net to make sure that no one is ever homeless, and if they go into care, that there will always be some support if needed. In addition to the means tested system, there's been talk for at least the last decade about a system where there will be a cap put on costs so that people won't have to spend down every last penny. There will actually be support much earlier. The lifetime cap was originally going to happen in 2016, actually at an amount of £72,000. Then it was cancelled. Then they reintroduced it and said that there will be a lifetime cap of £86,000 so that no one has to spend more than £86,000 in their lifetime. I would normally in previous webinars have explained and spent a couple of slides talking to you specifically about how this would work. And at the end of it, you would see that it was nothing like an 86,000 cap, because it was only the local authority contribution for care was going to count, not what a self-funder was actually paying. So for most people, it's going to work out at about 4 years before they reach the cap, and they were still going to have to pay the lion's share of the costs. So it really wasn't how the headline grabbed you and how it sounded. But in any event, what we now have is another cancellation, not even a postponement. The lifetime cap is simply not going to happen. A lot of it was driven by the workload that was going to be put on an already stretched set of social workers. But honestly, you can watch sort of some back issues of our webinar where we do explain it. It was not what it seemed. So in essence, I don't think the fact it's been cancelled is going to affect too many people. So we don't have to talk about that anymore. Moving on. The second stream of funding I mentioned, and this could be an event in itself, but I wouldn't be running it because I'm not medically qualified. So somebody much more knowledgeable than me could talk to you about the sorts of conditions that would be covered. But what I just want to make you aware of is that if your care needs are much more of a healthcare need than a social care need, so social care is the help with getting dressed and washing and feeding yourself, etc., help perhaps getting in and out of bed, those are all things that can be done by a carer rather than needing to be a medically qualified individual. If, however, you are predominantly needing the help of nursing staff, the sort of care that you would be receiving in a hospital, well, of course, in a hospital it's free. It can still be free in a care home, but only if your needs are primary healthcare needs. They are complex, they're unstable, they're unpredictable. There is again, a wonderful Age UK fact sheet that talks all about NHS support and what sort of things they're looking for when they do the assessment as to who would qualify. It's something that probably isn't appropriate for most of you looking at residential care, but might be something that would feature later in your care journey. So if you suddenly started to need some sort of nursing care, if it were a low level, the NHS pays about £236 a week directly to the care home to sort of cover the additional cost, hopefully. But then if your needs are greater still, the NHS might pay for all of it. So just be aware of this, as I say, not applicable for residential care, but something that might be appropriate later. Then what puts you in the self-funding category? Well, elimination. If you're not eligible for local authority funding because you have too much money, and you're not eligible for NHS funding because you're not poorly enough, that's what puts you into the self-funding category. And really, as far as state support's concerned, All that there really is initially is attendance allowance, which if you haven't heard of it, get in touch and we can give you the link to claim it. We can even send you a link to a YouTube video that shows you gives you tips on how to fill in each page. 2 rates, one according to whether you just need somebody to attend to you during the daytime, higher rate if you need attendance at night time as well. It is tax-free, it's non-means tested, and it is just for self-funders. So it genuinely, people think perhaps it stops when you move into a care home. It only stops if the local authority takes over the payment of your care. Otherwise, the only other sort of state support really is for people who have a property but limited cash. So the cash is under the 23,000 threshold, but they have this house that no spouse or relative over 60 is going to stay living in. If that property is going to be vacant and the move into care is permanent, then for the first 12 weeks of permanent stay in a care home, the local authority has to ignore the value of this property. If they ignore the value of the property and the cash is under 23,000, then effectively you become a local authority funded individual for 12 weeks. So all of those rules that I explained earlier, they all apply. The local authority pay for you, but they limit what they pay for you, and you're expected to contribute your income towards what they pay for you. So actually, it might only be a £200 or £300 a week contribution that you get, but you haven't got to pay it back. So it helps. The local authority can't tell you which care home to go to because you're a self-funder. You're only getting their help for the 12 weeks. So they can't say you have to go to one of the homes on the list. You go where the heck you like because you're going to pay for it ultimately, because they're only ignoring that value for 12 weeks. Care home can, of course, charge a top-up during that 12-week period because you are a self-funder. So those rules that we looked at before don't apply. And this is such a complex area because even some of the social workers just go straight into, oh, your local authority funded, so you have to go to somewhere we negotiate for you and you can't top it up yourself. They tell you all of these things, but actually, if you've got a house, you're a self-funder, so those rules don't necessarily apply. So it's a really, really complex area for little benefit, quite frankly. People have to jump through a lot of hoops getting the care needs assessment done because they have to agree that you meet their eligibility criteria first. You've got to wait in that queue to have the assessment done, go through then the financial form, and then it turns out that you are only going to get maybe a £200 or £300 a week contribution for 12 weeks. Some families just don't bother, but I need to make you aware of it because it is an entitlement if you fit that criteria. Now, the idea of the 12-week disregard period was brought in really just to give people, families, attorneys time to think about what to do with the house. I said to you, does a house have to be sold to pay for care? Well, no, it doesn't. It could be that the family decide, actually, it's in an area where we could get some good rent. It's in an area where we'd command a good rental income, and actually that would make the money go further. Now, some of you may be ahead of me thinking, yes, but even if we got good rent, and we know we've got to pay tax on that and agent fees, and we might have a void period, all the rest of it. Even if we got net rent of £10,000–15,000 a year, when we add that rent to the pension and the attendance allowance, it's still not enough to pay the fees. So we can't do it, can we? And some people might be thinking, well, we could, if we could get equity release. I've heard of equity release. You can't get equity release on a property where the owner doesn't occupy it anymore. So in this scenario, the owner has moved out into care. Any existing equity release has to be paid back, and you certainly couldn't get a new scheme. However, you could borrow money from the local authority. So in effect, the local authority offers a deferred payment equity release by another name. There are some caveats, of course there are. You have to meet the care eligibility criteria first. So if they don't think you need to go into care, they're not going to lend you any money. You can't have an existing mortgage debt against the property. It has to be unencumbered so that they can register first charge. And it has to have at least really normally 2.5 years worth of equity in it so that the loan doesn't sort of eat up the value of the property really quickly. So they might say no to a low value property, and they can say no if the property's got any damage, any anything that a normal mortgage company would say no to. So all local authorities have to have a scheme in place, but as I say, they can say no for those reasons: low value, already got a mortgage, or got some structural issues. They can and will charge you a setting up fee and some interest, but it's going to be cheaper than an equity release mortgage would cost you, and certainly cheaper than any sort of bridging loan, etc. I mentioned you do have to meet their eligibility criteria, and you can only apply for this if your assets are under the threshold. What the good news is that they can have the discretion to lend you what you need rather than capping it at, say, £600 or £700 a week, which might be what the local authority rate is. So it genuinely means you can use it for a long-term scenario, rent the property out and borrow the £1,000 a week that you're short by and just pay it back when the property is sold. So you can use it for that long-term scenario with a tenant, or you might just use it for the short term if you thought it was going to take 6 months to get the property done up and ready for sale, and then, you know, a few months to actually get it sold. You might want to access this just for the short term. But it must always follow on from the 12 weeks. It can't you shouldn't be just going straight into a loan arrangement with the council. You should get the free money first, and then this kicks in from week 13 onwards. So there's lots of pros and cons to think about when retaining the house. Do I sell? Do I rent? Well, we can have those holistic chats with you. We can't give you legal advice about the local authority scheme itself, and we can't comment on it. You'd have to get the actual interest rates and fees from the council. We could certainly talk to you holistically. Is it a good idea? How does it compare with the other options? So taking it to sort of more broad self-funders, people who've maybe already sold the property, or they've got savings above the 23,000 as well as the property. When we talk to those families, and they're generally giving us a call, we're getting these sorts of calls every day of the week because people are being given our information when they're sourcing a care home. There's two things that they share with us time and time again. We're choosing a care home for mum. We've been told what the weekly fee is, but we don't know how long mum's going to be in the care home. So how on earth do we know how many weeks to multiply that fee by? So it's really hard to do a cash flow forecast if you don't know how long somebody's going to live in the care home. Also, a common mistake that's made is people just multiply the weekly fee by 52, divide that into the savings to see how long the money would last, forgetting that that weekly fee is actually an all-inclusive fee. And that the money that they used to spend, their pension that used to have to be spent on the gas and electricity and Tesco's or whichever supermarket is used, that money now can be used to put towards the all-inclusive fee, because that is they're not going to have to pay their bills and food on top. So rather than multiplying the gross fee by 52, let's take off the income that someone has and just multiply the shortfall by 52, and then divide that into the savings. And suddenly, when someone thought the money might only last 2.5 years, it might actually last for 4. So it could just be a very simple cash flow forecasting exercise that we do with you when we speak to you. But that is a worry for most people choosing a care home. The second worry that they have is, okay, because even if we do that calculation and it looks like the money would last 4 years rather than 2.5, what happens if mum does live longer than the 4 years? And that's a genuine concern. So what our job, if we take it right down to the very basic level, our job is to try and address these two concerns for families. So we will share with them a solution that roughly 85% of self-funders never ever get to hear about. It won't work for everybody. There will be some people we'll talk to that when we do that cash flow forecast, turns out they've only got enough money to pay for a year. We'll tell them probably it's a good idea to go back to the care home and let them know that, so that you can decide whether that home is for you, whether they would still accept you with a year's funding, and just have that open conversation at outset, not wait the year and then see what happens. For people who have got enough money to pay for themselves, probably for upwards of about 3 years, there's a solution that might be appropriate for them, but as I say, the 85% likely never heard of. I'm not telling you about this today because I think it's something you should have. I just think it's something that you should know about, and then you can choose to explore it with us, go through the concept as it fits your specific scenario, and we can tell you whether we think it's even worth exploring. The key is to at least know about it. So what am I talking about? I'm talking about a way of capping care costs yourself, and it's a type of insurance. So it is possible to insure care home fees. But when we talk about insurance, we usually think that that's something that you have to do in advance. So of course you have to insure your car before you have an accident. You can't insure it afterwards. You certainly have to insure the house before there's a leak or a fire, etc. However, with care home fees, you used to be able to insure them in advance, but you can't do that anymore. All those products have been removed from the market. If you have one, it will still be honoured, but you can't buy one. You can only buy care home fee insurance now, either as you move into the care home or as you employ a carer at home, or at some stage after you've moved into the care home. It starts to look less attractive the longer you've been in the care home, because obviously the money that you have available to spend on one will be going down month by month, but you still can buy one even if you've been in care for a year, if you can afford it. So I use the term insurance just because people tend to understand that, but the technical actual product name for this is a care fees annuity. That's what you would plug into Google if you were looking to find out a bit more information about it. But you see, the word annuity isn't very popular either. If you say to somebody, I'm thinking about buying an annuity, often, even if they're in my world, even if they're accountants, bank managers, IFAs, they might say, oh, you don't want one of those, they're really expensive. Well, I'd always say find out first, and who is to say what you would be prepared to spend. I think usually they're getting them confused with pension annuities, and pension annuities historically have been poor value or expensive. But if you take the similarities, which they're both called annuities, but one is set up for your retirement and one is set up to pay care fees. Somebody buying a retirement policy, pension, retiring, normally that would be happening at 60, 65, maybe 70. People often are still in good health at that point, and they may want, for example, a widow's pension attached. So what looks like a really big pot of money that you've saved up over the years, you give it to an insurer who's thinking, well, we might be paying out for the next 20, 30 years. They don't give you a huge income from it. Somebody buying a care fees annuity, probably our average client age is 89. So they're not going to be expected to pay out for 20, 30 years. They might expect to pay out for 5, 6, 7 years. And this person is going to have some health issues, I would suggest. Otherwise, why are they moving into care? So that would be taken into account as well. So the concept of giving a lump sum to an insurance company up front and getting a tax-free income for life, that brilliant applies to both policies, lump sum, get income. But with the care fees annuity, they are medically underwritten, take into account the person's age and their state of health. So the income that you get from a lump sum will be much, much higher. Pension annuity, you might be getting 5% as a return. With a care annuity, you might be getting 25%, even 30% as your return. So that's where I think if you're not talking to a specialist, you might just sort of get dismissed with, oh, they cost a lot. Well, let's find out and let's compare it to the alternatives and let you, the family, decide what price you're prepared to pay for effectively peace of mind, because the idea of the annuity is that once you've paid that lump sum, you've got that income forever. You've got that income for however long the individual is living in care. And it's really down to families to decide what price they will put on that peace of mind. I would say you can never think about these annuities, you can never use the word invest, because once you've bought one, the money's gone. These are a gamble. They are a gamble around somebody's life expectancy, because you could put the money in and the person dies after a short while, and that money is not refundable unless you've built in some extra capital protection options. But having a pot of money sat there in the bank or building society or invested, side note, investment in stock market for somebody of this age where you're needing to access quite a lot of it, acting as power of attorney, I think you might not want to be taking those sorts of risks. You might want to be keeping things in quite a low risk area. If you are pay as you go, that still has risk. Yes, you can touch the money, it's still there in the early days, but as time goes on, that money could run out. So that carries a risk. They both do. One's a risk of somebody living a long time and the money running out, and one is the risk of somebody dying early and losing some money. So it's trying to balance the two. In certain situations, you could arguably do a bit of both. But again, that's what a specialist advisor would need to talk you through, the pros and cons. So what we do, our role here at Eldercare is, if you like, that sort of meerkat intermediary. It's our job to work out what's needed, go off to the insurance companies that offer these policies and come back and tell you what the costs are, what the options, add-ons, bells and whistles are, and to answer all your questions. So we do that in a written report, care fees funding report. And as I say, that answers all the sorts of questions you're perhaps starting to think about now, such as if we bought one and mum moved to care homes, where, does the income go with her? Yes, it does. What happens if fees go up? Well, they will go up. It's just whether or not you build in provision for that within the annuity, or whether you say, actually, we'll buy a cheaper policy that doesn't have indexation and we'll put the money to one side and fund the fee increases from our capital. That's totally your prerogative. We'll advise you on the pros and cons. And because of that risk involved, we will talk to you about the cost of putting in extra capital protection if that bothers you. And there's also an option to buy the policy with a delayed start date. So this is a bit almost like having voluntary excess and increased excess on your insurance. Because the annuity company doesn't have to start paying the income out straight away, if you defer the start date, it will be cheaper to buy. And if it's cheaper to buy, you are risking losing less if the person were to die early on. So it's a concept that, unfortunately, a lot of care funding advisors don't even bother to mention. I don't understand why, because it's a legitimate way of protecting capital. Rather than paying even more money to the insurer, you pay less to the insurer, and therefore less is at risk. So we'll talk you through all these options as standard within our report. One of the other things that lots of people ask, and that is worth a mention, even though it would be in the report, is these policies are properly protected. They're covered by the financial services compensation scheme. So if the insurer goes bust, 100% of the income that you've bought is protected and will carry on paying out until that person's died. That's quite a lot of information to throw at you about the annuity. So I wondered if it's helpful just to sort of touch on a brief case study that might resonate more clearly. Now, Mrs. Evans is fictitious, but she is very representative of the clients that we talk to, or the family scenarios that we address. So she's aged 88. She's had a stroke, therefore she, in her circumstances, can no longer live independently at home. What she and her family did was actually build a bit of a relationship with care homes near her before she'd had this stroke, just sort of forward planning, so that she knew if the time came which particular care home she'd like to move to. But now that we've sort of come to it, now that we're at that crunch point, the family are concerned whether she can actually afford it, because the stroke has obviously caused her some issues, but she's recovered from it, and she could be in the care home for many years. She had let the family know that she definitely wanted the grandchildren to some inheritance, and she did want to leave some money to the charities that she'd always supported. So that's not an unreasonable wish, but the family wanted to talk to us to see whether this could be achieved. So we asked them just some headline figures, really. We didn't need to know the nuts and bolts or the nitty-gritty. We just needed to know broadly what the care home is going to cost, and in this particular case it was $1,200 a week. We wanted to know roughly how much income she'd got, and she was already claiming attendance allowance. She had a state pension, so she'd got about $15,000 a year that she knew she was going to carry on getting. She doesn't need it for anything else. It can go towards the fees. That left her with just short of a £48,000 a year funding gap. That's what's going to have to come from her assets. Her assets were basically cash at bank enough to pay for about a year, and then a property. We'd already had the conversation, do you want to rent, do you want to sell? And they kind of thought that they were going to have to sell it at some point anyway. So let's sell it now, and then we've got a choice what we can do with the money. So her total asset position, around £300,000. So she could just pay as she went along, of course, But there was a possibility for her at around age 94, if she lived in care till she was 94, that money would all have gone. That was assuming fees went up by 5% and her pension and attendance allowance went up by 3%, and that any personal spending money that just came from the interest. So risky, who knows? We don't have that crystal ball, but the family was certainly aware that the money could run out. So we spoke to them about the care fees annuity option. We went through our research process. We asked for the quotes for the 48, just under 48,000 a year. And the insurers came back to us. We wrote the report giving all the options, the bells and whistles, and the family ended up basically spending £165,000 of that 300,000 on a policy that would pay the 47,400 for the rest of Mrs. Evans' life. That's broadly just over half of the estate spent, gambled, to protect just under half. In this scenario, as I recall, they didn't choose for any other capital protection. They weren't concerned about that. They were content that the 45% that was left over, was more than adequate for those grandchildren and the charities. And as I recall, they didn't build in escalation. They were comfortable that they could just use the interest on that remaining money to fund the fee increases. But everyone makes a different decision. This was just how it worked for this particular case, whose name I've changed. So what the graph looks like is very different. You see a massive dent in the savings to start with, or the assets to start with. Then it levels out and it stays level, meaning there's always money left in the estate. This assumed that the interest on that remaining money was stripped out to pay for her hairdressing and chiropody and gifts at Christmas. But of course, if she hadn't have needed that, then you would have seen the graph line start to slightly increase over time. So it's different strategies. The point is, you've now got two funding strategies to choose from, rather than the default of just running the money down over time. So you'll see why people choose to do this, why it might appeal if the figures are right. It ring fences the remaining assets. You know where you stand. You never need to worry about asking for local authority support in the future. You won't get it because you've got too much income. The annuity, the attendance allowance, the pension, that will all add up to more than the local authority would ever pay for you. But you don't need local authority funding because you're not going to run out. So it doesn't matter. If a care cap or similar were ever reintroduced under the old rules, any annuity wasn't going to affect that entitlement. And should you qualify for NHS funding in the future, again, the annuity becomes surplus to requirement, but the insurance company still keeps paying. It just pays the individual rather than the care home. And there's a little bit of tax deducted in that scenario. So it's truly an income for life. It never stops until the person dies. I said to you at the beginning, because we have this sort of remote model where we can advise by phone, by email, by post, we're not coming out to see you. We're not offering those face-to-face that sort of take 3 or 4 hours out of everybody's diary. Because we do it this way, we don't have to charge you for researching this option. So we can have a chat, we can give you a realistic idea of whether it's even worth pursuing. So if you tell us what the financials look like, we know from our data of quotes we've obtained for other people whether it's even worth looking at. So that saves you going to an inexperienced advisor who fills out all the paperwork. You take 2 months going through the process just to find out it was never going to be affordable in the first place. We've got the experience and the data to tell you roughly what it would cost. And we can then get you those actual underwritten quotes and write that report for you. And you can walk away then and say, no, it's not for us. We think it's better to just carry on doing what we were planning to do. And you haven't got to pay us anything. That's a really unusual business model. We can do it because we're specialists, because we're busy enough, and that when people do make purchases, we do get paid a fee that's built into the cost of the quotes, and that, if you like, cross-subsidises it and allows us to offer all the free work. And you don't know when you enter this process, with the best will, even if you think you want one of these, you may end up deciding not to. So it would probably be preferable for you not to have spent a few £1,000s on fees to get to that point. That's our view. It's as transparent as it can be. We disclose it all to you in a client agreement before you even instruct us, and it seems to work well for the majority. There are other charging structures out there. There will be other advisors who will charge you for the research, charge you for the report, etc. We also, by the way, don't have any ongoing fees. If you need to come back to us to discuss things once the policy's been set up, there's absolutely no ongoing charges either. I am just giving you this just so you know how limited the market is. There are only 4 insurance companies that offer these care fees annuities, and we've heard of people again going to IFAs that don't really know what they're doing. They don't do this as a living, they do it on the side, who say, oh, there's 30 or 40 companies that do this. Well, they're researching the wrong type of annuity. They're sending you down the pension annuity route, and that is not the right product for this scenario. You need the bespoke care fees annuity, and it's only offered by these 4. You cannot go direct to these companies. They want you to talk to a specialist because you might not need one of these policies. What if you were supposed to be funded by the local authority and bought one of these, you know, got an equity release from the house and you shouldn't have, etc., etc. So it's a minefield. We will protect you. We stand by our advice. We go to all 4. At Eldercare, we have an excellent relationship. Why wouldn't we if we're placing lots of business with them? So quite often we can pass down a negotiated discount to our clients that more than offsets our fee. Legal and General and National Friendly actually used our company to launch their product with. We had an exclusive arrangement with those 2 companies for about a year. So that's how highly regarded we are. So the point is, if there's only 4 insurers that offer these products, you don't need to shop around because the advisor you instruct will do that for you. Whoever you instruct should go to these 4 to get the quotes. And actually, if you go to 2 brokers that go to these 4 companies, it gets terribly messy and everyone gets in a muddle, and one of the advisors will not be able to provide updates or tell you what's going on because the systems only allow one broker to have access. So there really is no benefit in this particular scenario of shopping around. What you should do is shop around for the advisor, for the broker who's going to go and do this for you. As a bare minimum, they should be SOLA accredited. We are at Eldercare. As a bare minimum, you should be able to make sure that they're properly regulated and you can easily find them on the FCA register. I personally think the most important thing, and I do this when I'm choosing a hotel or a restaurant, okay, that's TripAdvisor, but for financial services, Trustpilot's a good place to go. We get our clients to leave reviews on Trustpilot because they're independently verified. We're not making them up and telling you how good we are. They're saying it. So go and look for independent reviews about the broker that you're thinking of using. Make sure they're reviews specific to care funding advice. There's no point finding a broker who's brilliant at mortgages or brilliant at investment advice and running investment portfolios if you're looking for care fee annuity quotes and advice around that product. So we're very proud of ours. We think there's no reason you'd need to use anybody else. We've got these reviews, we're SOLA accredited, and we're not going to charge you if you walk away. You may feel differently, but my point is make that decision around the advisor and just choose one. In closing, I've landed on this particular page of our website purely because it gives you a bit more information about the care fee annuity product, and it has a ready reckoner on there. This is only there to give you a rough idea of what the care fee annuity quote is. It absolutely will change if you go through the underwriting process with us, fill in forms to get underwritten quotes. But if you just want a ballpark, you put in the age of the person, you put in the cost of the care or what you expect it to be, and you put in how much income that person has, and it will tell you, based on quotes we've obtained for other people of the same age, it will tell you what the average cost is likely to be for a basic, no frills, no indexation policy. If that figure in itself makes you absolutely fall off your chair and you know that you've put in all the right numbers and that's no way affordable, then it's, I suppose, saved you the research time. If you want to double check with us, do. But if it looks in the ballpark, then at least you know it might be worth exploring. That facility, the online Ready Reckoner, has 2 parts. The bit that you just put in the information I mentioned, and then it has almost a contact us form. If you think you've sent that contact us form and you don't hear from us, I promise you, we haven't received it. You've not pressed the button or you've put in the wrong email address or something, because we absolutely always respond to those requests within 24, 48 hours. So if you think you filled it in and you're expecting somebody from Eldercare to get in touch, you don't hear from us, get in touch with us. That's our free phone number there, the 0800 number. If you would prefer to just write to us with an outline of your scenario and we can respond by email, use the advice@eldercaregroup.co.uk email address. And as I say, we have a contact us option on the website as well, so you can go via there. So hopefully that has gone a long way to answering your questions. I've noted just a couple that were posted as we went through. Can you have NHS continuing healthcare support and attendance allowance? I believe you can, but that is one that it seems to different scenarios have played out. It's only sort of oh, that's a very good question, actually. Maybe it does. I'll come back to you on that one. If you email me, I will double check. I know that the attendance allowance 100% stops if you're local authority funded. I just can't remember off the top of my head whether NHS support, you still get it. You certainly don't have to contribute your pension or any other income towards NHS continuing healthcare, so you get to keep that side of it. And somebody's asked about ring fencing money with trusts. If it's a will trust where you have severed the tenancy, so you own a property as tenants in common, and your will says, I'm not leaving my half of the house to my spouse, I'm leaving it to my children, and the other partner says the same, then absolutely, when one person dies, half the money goes into a will trust. Therefore, the remaining half, that's all that is exposed for care. That's 100% legitimate, and lots of people do that for lots of reasons. If we are talking about putting the whole of a property value into trust while somebody still lives there and expecting the local authority to ignore the property value because it's in a trust, that probably won't work. They are very switched on about pursuing money in trust if it's been done to avoid care costs. So the other issue is if you've put property into trust but then you stay living there, you'd have to be paying commercial market rent to the trust. Otherwise, they just say, well, you're making out you've given it away, but you haven't given it away because you're still living in it, so nothing's changed. So again, let's get some specific questions privately if you want to talk about that, but that's as generically as I can answer for the purposes of everybody on board. And pursuing the 12-week disregard, no, it's only the first 12 weeks of a permanent move into care. So if you moved into care with £40,000, 12 weeks passes, then the money drops to the 23,000. You can't then apply for the 12-week disregard. It was just for thinking time at the very beginning, but you could apply for the deferred loan. Okay, so that's, yeah, the answers to those. So any other questions that are bespoke or specific, we are practically on time. So I'd welcome those just by email to advice@eldercaregroup.co.uk. The recording may not be with you this afternoon, but will certainly be available to you Monday. If we can get it to you today, we will, but if not Monday, please do pass that to other family members or anyone else that you regard as being potentially in the same situation or that would find it useful. So thanks to everybody. Thank you to B&M for arranging as ever, and do get in touch if you need further assistance. Thanks very much, everybody.